The wealthiest nation on the planet Earth currently carries a financial burden far larger than any other in history. For an individual, a debt of this magnitude would trigger an immediate seizure of assets and a permanent filing for bankruptcy. But nations operate under a different logic. Governments borrow to fund the foundations of society, including road networks, school systems, and modern hospitals. This credit also serves as a mandatory buffer during emergencies, covering the sudden, massive costs of military conflicts, economic collapses, or natural disasters. While borrowing is a routine function of government, the total global debt has now crossed tens of trillions of dollars, reaching a volume that dwarfs any previous period in history. This raises a question about why the standard rules of finance seem to disappear for states, and who exactly is providing the capital for these trillion-dollar loans. When we look at the absolute debt held by the world's largest economies, the United States stands in a category of its own. Despite obligations that now exceed the total value of many national economies combined, global investors continue to treat U.S. government bonds as a primary financial asset. This demand exists because the U.S. dollar serves as the world's primary reserve currency. This creates a global baseline of trust that the American government will meet its repayment obligations. However, total debt figures only tell half the story. To see the true pressure on an economy, we have to measure that debt against a nation's total economic output. When measured by this debt-to-GDP ratio, Japan becomes the world's true outlier. Its debt burden is significantly heavier than America's, relative to the size of its economy. Japan has maintained this massive debt level for decades without facing an economic collapse, leading many to ask how their system remains stable. The answer is found in the ownership of the debt. Rather than relying on international lenders, Japan owes the vast majority of this money to its own domestic banks and private citizens. While internal borrowing reduces the risk of a sudden foreign default, it creates a long-term challenge as Japan's aging population begins to draw down the very savings the government relies on. China's debt is tied to a different strategy, resulting from decades of aggressive infrastructure development by local governments and a heavily leveraged property sector. This contrasts with several European nations, such as Italy and France, which carry high public debt while experiencing years of stagnant economic growth. India represents a third path. While its government borrowing is high, the country is using that credit to fund a rapid, nationwide modernization of its infrastructure. India's known population and high rate of economic expansion provide a cushion that many aging, slower-growing economies lack. By directing borrowed capital into massive projects like this bridge, the goal is to generate physical returns that outpace the original loan's cost. This demonstrates the central rule of sovereign debt. A high balance is only sustainable if a nation's economic growth remains faster than the accumulation of its interest. This leads to a specific logistical question: who actually provides the trillions of dollars required to keep these governments running? The money doesn't come from a small group of billionaires, but from massive institutional entities, including commercial banks, pension funds, and insurance providers. These institutions act as intermediaries. The ultimate source of the capital is the combined wealth of millions of ordinary people. Anyone with a retirement account or a standard insurance policy likely unknowingly owns a portion of their government's national debt. A sovereign default hits individual citizens directly, as their life savings are often the final destination for these government obligations. While the total debt gets the most attention, the immediate threat to a nation's stability is the cost of the interest payments. When interest rates rise, the cost of servicing the debt begins to displace spending on every part of the national budget. This shift in funding leads to the neglect of essential public services, such as healthcare, education, and the maintenance of foundational infrastructure like the rail network. These interest costs create a physical impact on a country, resulting in the visible decay of public services and a lower quality of life for its citizens. Ultimately, the entire global financial system as we know it is built on a fragile psychological foundation of collective belief. If that confidence disappears, the reaction is immediate. Interest rates jump, markets enter a period of panic, and economic activity begins to stall. History shows that financial trust can vanish in a matter of days, while the process of rebuilding it can take decades. Borrowing money is a matter of signatures and spreadsheets. Ensuring the world remains stable enough to pay it back is the harder task.